Let me go ahead and introduce the group. I'll kind of do this in order. So right here we've got Mike Bennett. Mike is the managing partner of Crewe Capital, an independent investment banking firm focused on advising closely held and founder-led businesses. The Crewe Capital team has completed more than 500 transactions across a broad range of industries. Mike is also co-founding partner of Crewe Advisors, a multifamily office managing over $3 billion in assets, as well as Crewe Partners, an alternative investment platform. Mike holds a bachelor's degree from Brigham Young University and a master's degree from the Said School of Business at Oxford. Mitch Rencher is a managing director and partner at Sepio Capital, a multifamily office and institutional investment advisory firm. Finally, Randy Quarles is the chairman and co-founder of the Sinosure Group, a diversified investment firm with $9 billion in assets under management, with offices here in Salt Lake City and in New York City. Randy spent his career in a broad range of impressive senior roles in business and government. He was a senior partner at a large New York law firm, Davis Polk. He was partner at the Carlyle Group, one of the largest private equity firms in the world. And he has served in a number of roles with the Department of Treasury and with the Federal Reserve, where he was most recently vice chairman. So I wanted to end there with your background, Randy, and thanks again, everyone, for joining the panel, because to me, it's a unique treat to have you here and to be able to comment on what's kind of always on all of our minds of just, you've had a unique perspective on the markets and the economy with the Fed and everything else you do. So maybe share with us what you are seeing in this moment today and throughout 2026 in terms of the macro environment and the markets.
Sure. So let me try to do this crisply. It could go on. It could go on for a while. So I'll try to do it crisply. The positive elements, now that we have a year's experience, the positive elements pushing the macroeconomy are very strong. The U.S. economy is quite strong. The inflationary pressures that come from a strong economy, from tax stimulus, from a shrinking labor force, which puts upward pressure on wages. Labor force participation rate is as high as it has been in a very long period of time, again, notwithstanding some of these soft numbers you've seen recently. So that means that you're going to have a strong economy and upward pressure on inflation, and thus that Fed policy is not likely to be as accommodative. You're not likely to see as many interest rate cuts either at the speed or to the extent that markets are currently expecting. People think that Kevin Warsh is going to come in as Fed chair and Trump has a deal with him that interest rates are going to come down. That's not how any of this works. Being the Fed chair is not like being the CEO of your company. It's not like being the captain of a ship. It's kind of like being the only fire hydrant on a street with 60 dogs. You have to persuade scores of people for what it is that you think ought to happen, and they have their own views. And this macro environment that I'm describing has a lot of them, including some who are politically aligned with the president, some politically opposed, saying interest rates can't come down this fast. So I think that's the environment we'll see over 2026. Continued higher interest rates than markets are expecting, a very strong fundamental macro economy, upward pressure on wages.
Just to add to that, I think the new Fed chair, he gets one vote, right, on interest rates?
He has one vote.
And he has historically been very hawkish on inflation. But, I think his father-in-law is friends with Trump, so people aren't really sure how he's going to behave. I do think if interest rates, go up or down, it'll really affect the markets, which then trickle down to private markets. But yeah, it'll be hard to tell. But I think the way the market responded last week is very optimistic because it's relatively flat.
So maybe pulling that macro vision kind of back into our day-to-days, and then ultimately we'll pull it into the day-to-day of founders raising capital is, Mitch, let me start with you and for the rest of the panel. So in this backdrop of this environment, what are you expecting this year in terms of valuations from where they've been kind of last year, this year, deal volume, pent-up demand?
Yeah, certainly when it comes to exit activity, I think those types of opportunities, the exit volume should be there, we hope, throughout the remainder of this year. To Randall's point, the economy is quite strong. It's a really interesting, just studying market history a little bit. Since 1980, we look back at the markets and say when the economy is accelerating and interest rates are either stable or cutting, that means an 8 to 15% next 12-month return for the S&P 500. It's even better for mid-cap companies. And how that relates to you, entrepreneurs, is you trade much more along the same lines as mid-cap companies. So I expect that this will be a good economy for you. The prior panel was an interesting one to listen to because they're doing so much more with less. And there's two schools of thought, in my opinion, and how it would apply to you is, one, you can do more with less. There's studies from companies and others that 27 to 33%, we are more effective per head. So you could just do more with less, or you could really lean in on it and acquire more talent, each one of which carries with them an Iron Man suit of their own, and really just accelerate into what should be a strong macro environment.
Any other comments on what people are expecting in terms of deal volume or kind of valuations in this environment?
I can tell you what we're seeing. I think we've never been busier. So the investment bank at Crewe is so busy. And we focus on middle market, so I'm not really talking about IPOs as that's still pretty frozen. But there is it is a seller's market. I think like what you see in the public markets, credit spreads are tight, and I kind of see that as the same in private markets. Venture capitalists, at least the big ones, are getting private equity type returns for venture type risk, and that to me is kind of like a seller's market. So if you are contemplating M&A or capital raising, it's a very good market. There are a lot of things you need to do to prepare to take advantage and be one of those that gets capital and the right capital. But there's so much, like last year was a relatively low year for capital raising, but it was a high year. It was the second highest for private equity exit values. And what we're seeing is a crossover of pent-up demand of capital deployed, pent-up demand of liquidity, plus a record number of capital, even with the lower fundraising year, because you're seeing new investors enter the space that may not have been before. So search funds, fundless sponsors, strategics don't even show up on that list as far as capital raised last year, and we're finding many strategics that are well capitalized enter into M&A. And so I think it's going to be a phenomenal year. I think the recommendation is if you're contemplating doing anything, like start prepping now. Your bankers, your lawyers, your advisors, your quality of earnings, they're all going to be busy. But it can be a wonderful time. I think it's advantageous to consider going to market maybe before you even need to. You want to make sure that you are going when you're seeing an uptick. You want to make sure you're hitting your numbers. You want to show positive growth. And you certainly don't want to be raising when you have to. So if you anticipate needing capital in 12 to 24 months, I would start planning now.
What's interesting, and people have probably experienced this if they are VC-backed, is those funds are having a hard time raising their primary capital, right? And so that dynamic of, I have someone who's already invested in my company, I need a follow-on. Why is it so hard to get my existing cap table to follow on? It's a tough, until they sell some of their existing positions, it's tougher to kind of So curious if people have different views on that trend and just what you think that means for founders kind of raising capital in this environment, and whether you and your firms have experienced kind of any of that difficulty in the fundraising environment.
Yeah, I'm happy to jump in on that one. We have doubled down with managers. We have a relationship that we can vet their track record. So it's been a really difficult time for emerging managers just because the capital cycle hasn't been recycled.
Yeah, I think that affects as well the types of exits that you can have. So for a growth equity fund, such as we focus on in our private equity business, it would be very typical to have an exit by selling to another private equity fund. And that doesn't happen anymore because the other private equity fund usually doesn't have our low leverage model. They can only transact if leverage is cheap, and they've been waiting for 3 years for leverage to become cheap. And as I said at the outset, I don't think it's becoming as cheap as everyone is hoping over the course of the next year or even 2 years. So that will remain the case. So, we've been fortunate that over the course of the last year, we've had a number of exits, sort of a very high distribution ratio, but none of them were sales to what would have been typical counterparties for a firm like ours exiting. We had an IPO, we had a couple of strategic sales, we had a dividend recap, so a significant amount of exit and activity, but none of it in the way that you would have expected 4 years ago.
Yeah, we're working on a deal right now where the 3 top LOIs were strategics to private equity backed, the likes of Solomir, Bain, and then the others just a pure play strategic. So the buyer landscape has changed significantly, I believe.
Yeah.
Absolutely. But there's also new entries, right? New groups in general that didn't exist a few years ago.
Maybe a quick hitter, and then last one kind of on the private markets environment, and then we'll turn to the more tactical for founders raising capital. What is something unique or unexpected that you're seeing in private markets today?
I think there's 3 main things I see that maybe I didn't anticipate. One, on the high end, like with AI, we're seeing companies almost be acquired by taking their talent and paying equity type returns for this talent, but they're not buying the company. I mean, it's wild. Like, we've never seen that before. It's hard to understand how to even document that or advise on that. When you're advising a company, it's one thing, advising a buyer, it's another. And to see management teams pick up and leave for a $100 million comp package is just unprecedented. We've never seen that. And then another thing I never had seen before until recently is founders like padding the board. You used to get 1 or 2 board seats, right, when you raise capital. Or now the founders are requiring every founder be on the board, and they're controlling it, which is just another indication it's a seller's market. So as you're raising capital, I think those are 2 things to think of and have your advisors think through with you. And then the third, it's kind of a has or has not market. So we're seeing deals get done at record pricing, at record paces. We closed a big deal last year in 90 days for a control deal that's fast. And it went for a record price. And then you have decent companies that can't get anyone to the dance. And it's kind of the has and has nots. And I would just say, if you're really anticipating being in the market, get good advice, get prepared, make sure that if you go to market and you run a process, that you are positioned to actually get what you want.
Okay, finally, let's switch to a topic that I think would be probably most relevant. And all of us deal with founders and entrepreneurs constantly as investors. We could all probably tell some stories about the wide-ranging level of their kind of preparedness going into that. What is the advice or the perspective that each of you have on the few most important things that you would kind of recommend before people are going to either raise capital or sell their business?
I'm happy to jump in on this. This is actually what I'm most passionate about and feel like it pertains best to this audience. We all end up working for entrepreneurs, as you can tell. It looks like we're here for a job interview.
Yeah.
And I guess in that sense, it's true, is we all work for people that are creating the future. Those are the founders that exit their business and they create these institutions. The thing I would tell founders, the moment you have earned the right to survive as a business, Okay? There's these three things. If you've earned the right to survive either through profitability or through enough traction to where you're attracting Series Bs and Cs at extreme valuations where you're getting secondary opportunities, for example, that is the time to be preparing for exit.
To give some examples, like some estate planning takes time, and if you're going to participate in QSBS, which helps some of your proceeds be tax-free, if it's not set up right, you might have to do an F reorg, and that you technically need 3 years to get that gain or that benefit. So that's why they're saying plan now. Two practical things I would recommend on the business, maybe it's just a little different from what they had said on the personal. The two biggest missteps we see in Silicon Slopes is first, they don't know their fully burdened CAC. So every founder knows their CAC, but an investor views it as fully burdened. So if you don't understand your fully burdened CAC and you're in market, it's going to come to bite you. So make sure that you know that number and you're tracking that number and you know how to define that number. The second is almost every tech founder we've ever worked with in Utah is not tax compliant. So they're not Nexus compliant, meaning they start off in Utah, most of their revenue's here, it's SaaS, no tax. They get growing, they're doing business in 20, 30 states, each state's different. California may not charge tax on SaaS, Texas, New York, they might. There was in 2018, there's a case law that basically changed it so you no longer have to have an office to be charged sales tax. The reason I say that is if you are in a process and you're not tax compliant, it'll affect your equity value. You will have to hold back reserves, which you won't unlock that capital for a long period of time. And you could be hit for tax penalties. And it makes your probability of successfully closing a round a lot less likely. So make sure you're Nexus tax compliant, make sure you're paying state taxes in each state, you're filing in every state, you're staying ahead of that. And those are things that you should be speaking with an investment banker way ahead of time. They have a scorecard of 20, 30 items to keep you from tripping up and before you go, and try to raise before you actually need it. Those are some key takeaways.
Actually, my advice is exactly the same. It's something that we feel kind of very strongly about. I mean, if you're a founder of a successful company, you are completely absorbed in that business and completely absorbed in how to expand that business. And those are the sorts of founders that we back. That's what we look for, is someone who absolutely lives the business. But the downside of that is that when it does come time for exit, and we weed out folks who come to us saying, we're thinking about our ultimate exit. It's like, okay, that's very good. Next. But if you haven't planned for that exit, it will be, as Mitch said, too late when you realize in 6 months, I'm finally going to have my liquidity event. It's like, well, the IRS is going to take a big chunk of that if you haven't handled that years ago. And doing that is not in any way inconsistent with being totally absorbed in building the business. We really stress that with the folks that we back.
Well, with that, thanks everyone for coming to this panel, and let's hear it for our panelists. Thanks.